So then the demand pull began to backtrack and seize up the market. And then probably an over pendulum swing to the other direction is after that happened, of course, then is any of it good? And so these assets get devalued down and no one's buying it. And so what happens is the assets backtrack and investors get stuck with some. But you know, this is really moving fast. There's a lot of velocity coming through here. So the banks are continuing to originate this, especially the subprime stuff. The GSEs are continuing to buy it. The investors are the first ones that say, "Who? I don't want any more. Don't give me any more. I'm not buying any more of this. It's not what I thought it would be." You know, the car you sold me, it's a lemon. I'm not buying another one from you. Excuse me. So questions came on, are these being rated properly? It's common knowledge at this point in October 2008 that the rating agencies were overwhelmed with these kind of opaque instruments and weren't able to rate it, give their best shot at rating it, just because of the pure volume, partly, and also because of the complexity. But investors said no more. So the GSEs, government-sponsored entities, Fannie and Freddie Mac, and also investment houses got stuck with a lot of this stuff. They couldn't sell it all of a sudden. So what do you do when you have a financial asset that you can't sell? Guess what? You have to hold it. It's now your puppy. It's like a big game of hot potato, and you got the hot potato, and now you're holding it. And so the first wave, really in July of 2007, when we saw the crisis begin, was when two mutual funds that invested in the subprime paper and Bear Stearns went belly up. It was a major issue, maybe not as widespread as some of the later things that happened, especially as this thing unrolled during 2008. But in mid-2007, it was pretty much understood that the investors had a weary eye now about the stuff that they were being sold, a bill of goods, basically. Excuse me. And so, you know, the rating agencies then came under fire. That what are you selling us? Why are you rating this stuff so well when it's really not that good at all? And then, of course, the GSEs and especially investment houses, Merrill Lynch, Morgan Stanley, Bear Stearns, Goldman Sachs, and so on. They got stuck with a lot of the stuff. And then in the fall of 2007, of course, they had to write some of this stuff down because they couldn't sell it anymore. It's not worth $1 for $1. Now it's only worth 22 cents on the dollar. So then the next wave of what you saw in the financial papers and financial press is that these big mortgage houses started writing down tremendous amounts, billions and billions of dollars of losses, because they had, once they took these on books, the accounting rules say you have to mark those to market. And if there's no market, you're basically taking those and marking them to what you believe they're going to be worth, and you know, they're not worth much at this point. They're probably worth more than that, than the 22 cents that I believe it was Merrill Lynch sold, or Morgan Stanley actually sold some of these assets. So there's a backflow. Well, then you take one step back, and then you have banks that were originating these mortgage assets. That all of a sudden, none of the GSEs, no one wanted the subprime paper anymore. And if you were in a bank or had a brokerage arm, mortgage brokers, and you were issuing subprime paper, the music stopped in August of 2007. And all of a sudden the banks had to put all that paper onto their books. Well, banks aren't set up to put billions of dollars of mortgage paper, subprime mortgage paper, on their own ledger, on their own balance sheet. So in order to do that, they have to raise capital. In order to do that, they're all of a sudden taking a bunch more risk onto their assets onto their balance sheet, and so therefore you have banks getting into pretty bad trouble here in late 2007 all the way to 2008. There's never a bank out there that didn't get touched in some way by the subprime mess. Now, the other thing that's interesting is that the other thing we started here in 2008 is the banks that invested in these, especially overseas banks, German banks, French banks, Swiss banks, British banks that invested heavily in these subprime mortgages through these repackaged goods, and all of a sudden they weren't worth what they thought they were worth, so they had to write those down too. So you have Deutsche Bank and some others that wrote down billions of dollars. You have the big five, Bear Stearns, which, you know, got rescued in March 17th of 2008. And then, of course, in September of 2008, you had Merrill Lynch which was bought by Bank of America, Lehman Brothers, which was allowed to go bankrupt, and then Morgan Stanley and Goldman Sachs, which were transferred, which were translated into regular banks where they could take deposits. So there really isn't anything as a Wall Street investment bank anymore, and all of them got burnt some way. Even Goldman Sachs has gotten burnt some way, even though they escaped a good bit of the paper. So understanding, a little bit more understanding here, trying to get an understanding here of how the rating agencies are a key player in price discovery. Now what's interesting, if you were able to jump back in time to say 2002, 2003, and you were a manager of one of the rating agencies and you saw this wave coming of new business, because hey, the more you rate, the more you make as well. There's incentive to rate these things, these deals, these bonds. But if you saw this coming in, and not just that, but you were willing to say, I don't want this business, this, you know, hundreds of millions of dollars, I don't want this business. What I want to do is tell you that this stuff that's coming through isn't what you think it is. The loan loss rates that are modeled into this paper are not substantial enough. They're going to turn out to be a lot worse than you think they are. Quite potentially, in the early part of this could have been avoided in some measure. But given the way the market chain works, I would hardly be able to see that, lest you had some other third party doing some of the rating that had authority, and that didn't have a vested interest in rating many bonds. So, in my mind, being a financial analyst myself, of course, I lay a considerable amount of blame on the rating. Besides the entire market pull, at any point, if the rating agencies did come out and say, this subprime paper is not worth buying, we're rating it very low, then the investors, many of them, couldn't have bought it because they have certain rules written into their mutual fund prospectuses, etc., and the regulations that say we will only buy a certain quality of bonds. But if that were done, then you could see easily that if the rating agencies did pull the fire alarm early on some of this paper, that it may not even have been a news item at this point. But the fact is that this market exploded in between 2004 and 2007, especially in the subprime area. And there was a tremendous amount of market pull, because if I'm an investor and I say, hey, I can get 8%, it's pretty much riskless, why wouldn't I? Okay, let me have some more of that. And then you multiply that by foreign banks, etc. And I think a lot of the blame, besides rating agencies, falls on the end investor not knowing what they're buying. And the fact that these assets are tremendously complex isn't really an excuse in my mind. If there's something very complex, and let's go back to the example of the antique book, there's not many people that really understand the value of an antique book except antique book dealers who work in that market. So my point being that if there is some complexity involved in price discovery with the assets that you're looking at, with what you want to buy, then it's really the impetus is on you to understand the market and understand the assets that are in that market. Now you may use a third party to help you evaluate, but you're the one buying the paper. You're the one buying the antique book. The impetus is on you to understand what you're buying and what it's really worth. You shouldn't rely on third parties that much. Even a Kelley Blue Book, you should understand what the 1999 Dodge is worth inherently and kind of have a general idea, even without the Kelley Blue Book. Now the Kelley Blue Book should help, and the Kelley Blue Book should be accurate. So I think there's shared responsibility for a price discovery error that entered into the market.